Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Omnicom Group stock, ticker OMC. This one came in by request in the comments section of one of my other videos. If you have a request, put it down in the comments. And once I put it up on the blackboard behind me, I'll let you know that I put it up there. I run through every few days. It kind of depends if I'm near the blackboard or not, whether I'm writing them down. I try not to reply until I get them actually physically written down. Otherwise, I'll definitely forget a bunch of them. But if you have a request, put it down there. Eventually, I'll make a video for you. I post some videos over on Patreon now where I have a free tier. So I'm kind of splitting up the duties between for free on YouTube and for free on Patreon. And then over on Patreon, I also have weekly picks. Those are $25 a month. And if you join any of the paid tiers on Patreon, you get a big discount if you ever decide to join the full Cyclical Investors Club service on Seeking Alpha, which I've been running there since 2019 and been writing over there since 2015. So my 10th year now. I also have a 25% off affiliate link for Fast Graphs down in the description, which we're also going to be using here. So as always, this is not individual investing advice, just how I analyze stocks. Let's get into Omnicom. All right, first thing I like to look at is the historical earnings trend and patterns. Overall, it's pretty steady, but pretty slow, just glancing at it. Point to point from 20 years ago through this year, 7.26% earnings growth. That doesn't include downturns or the effects of buybacks, which I'll look at in a minute. Now, when we go back to the last recession, I always like to check for earnings cyclicality so I know whether it's a really cyclical business or not. So adjusted earnings only fell 20%. So that's pretty reasonable for the scale of recession that we had in 2008. What's interesting to me looking at this is the stock price appears to have fallen much deeper. It looks like it could be even 60, 70%. Let's see. Almost 60%. So about 60%. That's pretty close to in line with the S&P 500 overall during that decline. So maybe just slightly fell slightly more than the average S&P 500 stock. These guys do advertising, by the way. They also just announced a few months ago they were buying or merging with Interpublic Group, which I actually owned when they announced that. And it didn't end up like making me any money, unfortunately. They're just kind of slow. I bought it when there wasn't anything else to buy, or everything else was too expensive because it was just the valuations were really high and it seemed at least fairly valued. But so yeah, let's look at the valuation here. I would say there's one or two things worth noting. One would be during COVID, we have this 17% decline. Let me actually look at the basic earnings too. That might tell a slightly different story. Not really. No, looks about right. Okay. I hadn't looked at that before. Sometimes if the stock price falls a lot more than earnings, like 3 times more, that can be kind of a reporting thing on the adjustments that they're making. Like they might not really reflect like what the market actually believes. But that doesn't appear to be the case here. So, all right. So let's start with the earnings growth rate because we need that in order to determine the valuation. You know, if you just look at the PE ratio, that's only like part of the equation, right? So it's a 10 PE. That's half or less of what the market average PE is. But the problem is the market is probably growing earnings faster than these guys. So over time, that larger PE will come down. And if you go out long enough, it will surpass the returns of even a low PE / high earnings yield. So if you look at the earnings yield, which is just the PE inverted, it's actually 9.57%, which is really good. They do have some debt here, which would affect some of that too, affect some of that valuation. I would guess instead of like if you just look at their long-term debt right here, 60% of the capital is to long-term debt or long-term debt to capital. If you added that to the PE ratio, you would have more like a 16 PE right? If you included the debt. Now the S&P 500 has debt too on average, so it would be a little bit higher too. But you can see that it just doesn't, it's not quite as enticing, like a 16 PE, okay, with the initial earnings growth right here, which is at 6.72%, isn't too bad, honestly, for like a mature business. But I'm going to show you here in a second that that's not a very accurate number. For one, it doesn't include this downturn. Now, that wasn't their fault, but they had this larger earnings growth that kind of made up for it the next year. And if you were collecting earnings, this would be a year where you collected much less than the average. If you just took a smooth straight line average, which it almost actually is on this graph, in order to get this calculation of the 6.72%. Now, the issue here is over the past 10 years, which is about where this runs, they've bought back a decent amount of shares, like 20% of the company. So they steadily reduce their earnings per share, and that will inflate the earnings, or they steadily reduce their shares outstanding, which will inflate the earnings per share, right? As the share goes down, the share numbers go down, the earnings per share go up. So they really didn't grow real earnings before the buybacks at 6.72%. It's going to be closer to like 5%, a little under it when we get to my other spreadsheet here. So now we have, if we think about the debt, we have what, a 16 PE trading that's growing earnings a little less than 5% in a 3% inflation environment. So 2% real earnings growth if you're thinking about like owner's earnings and everything you'd have to buy the company. So just on its surface, like you can see that that's not like super cheap. Like it's not as cheap as 10, right? All of a sudden the valuation starts to make more sense. So let's get into the numbers here. Now, if we just use the straight up valuation, usually I want this to be at like 8%. This is the expected 10-year earnings CAGR. So how much you would be expected to earn CAGR-wise over 10 years if you own the business, right? 8% would normally be like a buy for me. It's like still a little too expensive even using that. The earnings growth rate was a little lower than I was talking about earlier, 4.34% once you adjust for buybacks. And worth pointing out, this is the 3-year revenue number. So this is how much of revenue's grown compared to 3 years ago. Sometimes this is 1 quarter short, just depending on how I updated it, like where I had that calendar set. Usually I just go straight to 3 years, and sometimes it's 2.75 years or 2.8 years or something, but you're getting the basic number here. And what I want to show is like this isn't compounded. This is just straight up. So if you divide that by 3, it's not the true math because you would be compounding things. But you can just look and say, okay, that's like a 3% earnings growth rate basically per year, or revenue growth rate. So revenues the past 3 years have been growing a little over 3% per year. Well, that's very much in line with the 10-year earnings expectation that I'm sharing here. And then when we consider that inflation's probably been slightly over 3% per year, we're looking at about 1% earnings growth rate per year. Real owners' earnings growth rate per year is what they've been doing. So it's just not growing very fast. And I think the valuation here is fair, honestly, because there's just not much earnings growth rate. There's also disruption going on in advertising. That's why they're merging with, what did I say, Interpublic or something? I used to own it, but I forgot the names. I own a lot of stocks. And I think that merger makes sense. They need to consolidate, advertising changing a lot, not even starting to think about like AI. It doesn't mean the businesses will not be able to stay in business, but they're going to have to come up with some kind of special growth driver going forward, right? And we don't have any evidence of that yet. So when I look at this, I see a fairly valued slow growth or no growth business. And, that's just the reason I don't have a buy price on it is because I want to own the stocks of businesses that can grow, that can pass inflation on if it comes along, which so far these guys have been able to do, but they're kind of teetering right on the This actually has only met inflation the past 3 years. So they haven't had any growth basically for 3 years. Any real revenue growth, I would say, for 3 years. Now, if you know all that and you don't care whether they have, whether it's a growing business like I do, and this is good enough for you, then I'll give you a buy price. Let's see. We want to get this. I'm pointing at it. You can't see where I'm pointing. I point with the cursor this time. We want to get this 7.42 up to 8% so we can lower the price and see how low it would have to be. I'm going to guess like 77 maybe. Almost right there. Yeah. So about $77 a share would be if you felt fine with the slow growth and everything and potential disruption, competition. If you felt fine with all that and you just want something that has a low PE, then you want like $77 is okay to come in here. I'm not going to do that just because that's not my style of investing though. Okay, hopefully you found this useful. If you did, hit the like and subscribe button. Check out those links down in the description for the free Patreon tier and the paid subscriptions that I have. And if you have any requests, let me know, and I'll see everybody later. Bye.